Happy Super Bowl Sunday. Today we are joined with one of the most trusted voices on the Federal Reserve and the global economy. Economist Ed Yardeni, welcome back to Navellier Market Buzz. Ed, it's great to have you with us. Few people understand the Federal Reserve and the global economy as well as you do, and we're looking forward to your insights.
Thank you. And I should add, Ed offered to do the job of the entire Federal Open Market Committee for half the price. And that would save taxpayers a lot of money, especially from that big Fed building that has the cost overruns in D.C.
Yeah, I would do it from home, so there's no reason for renovations.
Outstanding.
So, Ed, Kevin Warsh has been a sharp critic of quantitative easing and wants a smaller Fed. Do you expect a smooth Senate confirmation or a real pushback?
I think he'll get confirmed. He's a solid citizen. He's got a great resume. I think the administration is going to have to back off on the judicial attack on Powell, and I think that'll happen. I think Warsh will be appointed rather quickly.
So is Warsh going to push for real-time economic modeling at the Fed, like Christopher Waller's excellent work on the labor market? Because it seems like the Fed's always behind the curve. And I think Steve Moran's been calling for better economic modeling too.
Well, I don't know that models are going to get us ahead of the curve any more than humans will. I mean, the reality is we all respond to recent economic and domestic political and geopolitical events. And the models probably do that as well. And the models are pretty rigid. I mean, once you kind of model it, the only way you're going to know if it's close to reality is if it gets it right. And more often than not, it's not going to get it right. And so then you're going to go back and rejigger the equations, and suddenly it'll work for another month or two, and then it won't. So I don't have a problem with the way things are actually being done now. It's run by humans. It's not perfect, and I'm not sure that a model or a rule-based Fed is going to be any better.
I should add that I used to work for the Federal Home Loan Bank back when Volcker was the chairman, and he was doing all that monetization. I still remember going from 8.5 to 20 to back all the way down in 1 year.
Yeah.
I think they were trying to let the models run everything. And despite what Milton Friedman called for, that one didn't work.
Early on in my careers, I developed a distaste for econometric models. I don't think they're very useful.
Well, that helps a lot.
So if Warsh takes over, do you expect Jerome Powell to stay on the FOMC? And if so, does that force Stephen Moran out?
Well, I think that Powell probably deserves a break from all this and should spend more time with his family and in the sun on vacation. I suspect he'll leave.
Well, that's going to be exciting for President Trump then, because Steve Moran wants 150 basis points in cuts.
Well, yeah, but as you know, there's 12 voting members on the FOMC, and Warsh is just going to be one of them.
Yeah.
And I don't know that Moran wants to hang around at the Fed much longer. He already resigned from the Council of Economic Advisors, and I don't know, my hunch is Washington's probably not a happy place for him. He probably wants to go back to New York and the financial markets.
By the way, is your analyst still on the Council of Economic Advisors?
Eric Wallerstein worked for me for about a year, and this last May in 2024, he got a great offer to work for Moran at the Council of Economic Advisors. And when Moran went over to the Fed, Eric went along with him, and all of a sudden he's sitting in the FOMC meetings. So yeah,
wow.
He's had quite a career for a fellow who I think last I remember was about 27 years old.
Wow. Yeah, he's on the fast track.
Very impressive, and I taught him everything I know in a year. So I hope that rubs off on our government.
So that's why you're not Fed chairman, because he's going to be.
He's going to be it, absolutely.
All right. Rents have been falling for the last several months. Is the shelter inflation and the CPI and the PCE has been a sore spot? Is it going to cool off so inflation finally falls?
Well, the real hot area of inflation over the past few years has been durable goods inflation. And during the pandemic, we had the 2-month lockdown. When it was lifted, everybody had cabin fever. And to relieve that, everybody wanted to go shopping. They couldn't really buy much in the way of services because of social distancing restrictions, but they could buy goods. And so we went on a buying binge for goods, particularly durable goods. And at the same time, the pandemic caused supply chain disruptions. So put it all together, we had this huge increase in durable goods inflation. Whether you look at the CPI or other measures of consumer prices, that's where the real heat was. Also, clearly, other areas like rent, as you mentioned, heated up, but not like durable goods. And I think inflation would have been down to 2% by now if it hadn't been for the tariffs of last year. And again, you just have to look at the durable goods inflation rate. It had been back to negative, which is what usually we have deflation in durable goods before the pandemic, anyways. And we were kind of back in that territory until about when the tariffs were introduced, and that led to durable goods inflation being high again. So I think we're on track here to get down to 2% this year. I'm not particularly concerned about inflation making a comeback.
Well, that's good. Well, at least Pepsi cut the price of Doritos for the Super Bowl. So, yeah.
So at Davos, the ECB president, Christine Lagarde, reportedly walked out during Howard Lutnick's dinner speech. Was that symbolic or a sign of a strained U.S.-EU relations?
Well, look, I think the geopolitical landscape has changed pretty dramatically since Trump has come into office. The U.S. is being much more assertive about its self-interest, and they seem to sometimes collide, maybe even often collide, with what our allies have been doing. But it's all Trump's style. It's all a matter of the art of the deal and how Trump negotiates. I think that the Europeans have been called out properly by American officials on some of the areas where they need to make some progress, such as spending more on defense, having a more credible military, and deregulating their economy, creating an environment where there is venture capital that wants to finance technological innovation. So there's room for improvement in Europe, but there's room for improvement here as well. So it's okay for allies to have little shouting matches every now and then, but I think we're still very good allies. We'll come to each other's defense if necessary.
I have to add, I personally was amused when Howard Lutnick asked Mercedes to move to America. They have the huge operations in Alabama, and they politely wanted to stick to their German roots. But let's face it, they have that plant in Alabama because, they can make them a lot cheaper. Our energy is a fourth of their costs. And, I think we even offered to give their workers visas, in case we didn't have enough. But it's just fascinating to watch what's going on. So let's talk about China. They have this hideous deflation problem over there. And obviously, a lot of it's caused by their demographic decline. But it looks like that demographic problem that China has is obviously now enveloped Japan, Britain, and France. And the bond vigilantes seem to be really focused on Japan, Britain, and France. So I assume they're going to have to do quantitative easing. Do you think we're going to import any of this deflation? And do you think the quantitative easing is going to spread, which would weaken those currencies?
Yeah, well, the big problem is China is exporting deflation. They have a lot of excess production that they are dumping into global markets. So all these countries that are reaching out to work with China as sort of an offset to the less amicable relations they're having with the United States under Trump right now, all that, I think, begs the problem, which is China's consumers aren't very good consumers, and China's workers are very good producers, and they've got automation and they've got great supply chains, and that's creating deflation. So China is a source of deflation for the global economy, not just for the U.S. But all in all, I think that the outlook is not for deflation in the United States, but I think we'll see inflation stabilizing around 2%.
Well, that's good news. I guess Canada just approved the BYD cars coming into Canada.
Yeah, I think there's a limit of 40,000 or something like that on those.
Yeah, and they're already in Mexico.
I mean, the whole deal was kind of an odd one-off deal. I think Canada can export more, is it canola oil or more oil, and they can buy more cars. So it's not a grand slam trade deal. I mean, India so far on a global basis has been getting the big deals with Europe, with the EU, and with the United States, and so India, I think, is a contender for being a real alternative to China.
Yeah, the India trade deal is a big deal. It's going to be. I'm shocked that they promised not to buy oil from Russia because they're.
Yeah, that was a stunner. That was totally amazing.
They have all the refineries set up for that heavy sour crude, and we'll see what. I guess they'll go to the Middle East. I don't know where else it's going to go, or to China.
president said, we are an exporter of oil, so some of it may be from the U.S. and some of it from Venezuela.
Yep.
So, Ed, you called gold at $5,000 early. Do you think $10,000 by the end of the decade is possible?
Yeah, I have to say, I'm not an expert on gold. I've never had an opinion on gold until 2024 when it rose above 2,000. I had an opinion that it just broke out to a new record high, and I could explain it with central banks buying more gold because of Russia invading Ukraine, and then we froze the foreign exchange reserves of Russia, so did the Europeans. And so several central banks said, well, in that case, let's buy gold. That was an easy call, that we were in a bull market on gold. And then when I got to 3,000 at the beginning of 2025, I looked at the charts, which is kind of the only tool I had, said, this could get to 4,000 by the end of 2025. Well, it got to 4,500 in a jiffy. So then I raised my target for this year from 5,000 to 6,000. And I'm going to stick with it. Gold's gotten a lot more volatile, but I'm not in the camp that thinks that gold is topped out here. I think it's going to go still higher. And I've got $10,000 per ounce by the end of the decade, by the end of 2029. I think we kind of share that opinion.
Yeah, I said that on Maria's show. So it better come true, Ed. Okay.
Well, it's I do have one chart that I'm kind of relying on, and that is if you put the price of gold on the same chart as the S&P 500 using the same scale. So gold is now just south of $5,000 an ounce, and the stock market is just south of 7,000. So put them on the same scale on the same chart with a ratio scale, and you see that they're inversely correlated, which makes gold a way to diversify your portfolio. But they have the same trend, and so I do think that the S&P 500 is going to get to 10,000 by the end of the decade, and that's based on my belief that we're not going to have a recession and that earnings can get up to $500 a share by the beginning of the next decade, 2030s, and that the market will be discounting that in of $500 a share times, let's say, a multiple of 20, which is high, but it's certainly plausible given where we are now. That would get you to 10,000. And if the S&P 500 gets to 10,000, I think there'll be a lot of people nervous about how much money they're making, and there'll be diversification into gold.
Yeah. I just hope all the crypto people just shift to gold. I don't know why they're tormenting themselves right now with crypto.
Yeah, well, they said that Bitcoin is digital gold, but gold is physical Bitcoin. And I've never been a big fan of Bitcoin, but you couldn't say that too loud too often, because they get really mad at you and say you were an idiot and didn't know anything about how things really worked. Looks like the old-fashioned way of looking at assets might actually be working here.
Yeah. Well, we've talked about how some of the crypto ETFs are actually falling faster than the price of the cryptocurrencies. There seems to be big spreads on those ETFs, and that's not helping confidence.
Yeah.
Even though, the SEC chair is trying to, get everything going. And so all the crypto tradings in America, well, it's compound complex, like a lot of things. Your observation that gold and the S&P are moving in the same channel is very important. I can tell you just internally, if you have gold with your tech stocks, so one zigs, one zags, it does cut the intraday volatility, even though they're moving in the same channel. So there is a place for gold in the portfolios, as long as all that volume persists. I'm actually out in Nevada now, and the mining here is just unbelievable. They have this heap leach method just to move mountains to get so many ounces of gold, and now they have new technologies, or they're adopting some of the fracking technologies. So it's going to be interesting how much gold we can mine and how much we export. So that leads me to the next question. So we have a situation where a lot of our GDP growth seems to be coming from the trade deficit that was for a while shrinking. But with all the onshoring and obviously our energy exports are rising now that natural gas prices are so high, and we're the Saudi Arabian natural gas, and we export a lot of crude oil and refined product. Are we going to be able to actually close the trade deficit?
Kind of doubt that anytime soon. The president wants to go in that direction, but I'm not really particularly troubled by the trade deficit as long as it's balanced, as it always is, by capital inflows, but in a way that doesn't depress the dollar. I'm not bearish on the dollar. I'm not super bullish, but I think the dollar is going to hold its own. But I don't see anytime soon that the trade deficit's going to go away. But the president's doing his best to make it.
If housing rebounds, can the U.S. sustain a 5% GDP growth, and is a brief move to 6% realistic?
Well, I think much obviously will depend on productivity. And productivity last year was a great year for productivity. It looks like it increased by 2.5% to 3%, maybe even more than that. We'll see how the fourth quarter pans out. But it does look as though the technologies we have, including AI, but not only AI, are increasing productivity. I think every company over the past couple of years has basically decided to freeze their headcount, their payrolls, while they assess how AI can make a difference to their operations. And I think they're going to find that it's kind of hit and miss. Some areas it can really be helpful. Other areas it's not ready for prime time. But everybody's looked at their operation top to bottom, and I think that's a good thing to do every now and then if you want to increase productivity. So I think productivity growth could be 3% to maybe 3.5% this year in the next couple of years. I've been calling it the roaring 20s, based on the idea that productivity would in fact increase because technological innovations would allow us to augment the productivity of workers, and workers with the skills we need are in short supply. So we need the productivity tools to make our workers more efficient, and I think it's starting to happen.
So consumer confidence just hit a 12-year low, according to the Conference Board, and according to Challenger, the January layoffs, corporate layoffs, were the highest since 2009.
For a January?
Yes. What's the significance of January? I mean, I know there's the Labor Department has seasonal adjustments, but the Challenger report,
yeah,
they're a placement firm. So I think those were real layoffs, or do you think that there was a seasonal distortion there?
I think if you look at the chart, it's just been very choppy and volatile. I mean, I tend to focus more on initial unemployment claims, which are available weekly. They give you a much broader sense of whether there's widespread layoffs going on. These are announcements, and I think they're kind of global announcements. They're not just limited to the U.S. Mm-hmm. And we have had some rather major global firms like Amazon announce that they were reducing their headcount. But I think the labor market's kind of quiet, stable. We're not seeing a lot of layoffs, and we're not seeing a lot of hirings. People aren't quitting their jobs. If a lot of people were quitting their jobs, there would be more job openings. So it's actually kind of relatively calm. We're not hiring a lot of people on a net basis, and yet the economy is booming. All the more reason. I mean, clearly that implies that productivity is doing extremely well.
So do you think consumer confidence can improve? It's a big part of our economy. I don't know if some of it's weather related, because a lot of people in the United States are popsicles right now.
I think a lot of it's actually related to demography. Young people are not happy. It's hard for them to find a job. Many of them are coming out of colleges with degrees that with the same kind of degrees, business, communications, marketing. They're kind of competing with each other, and they don't have the kind of specific skills that are needed in the labor market right now. There's a relatively high unemployment rate for people coming out of college, and then they're also saddled with student loans. But I think there's a lot of intergenerational transfers of income going on here. I think a lot of the baby boomers have done extremely well. Collectively, they're sitting on $85 trillion of net worth, and I think they're helping their younger adult children and grandchildren financially. I think that's a big part of why we're seeing such a depressed consumer when you look at the surveys, but when you actually look at consumers, people are actually spending. I've always said we Americans are amazing. When we're happy, we spend money. When we're depressed, we spend even more. And maybe some of the younger folks are getting some significant financial assistance from their parents. I see that personally. I see that going on with my friends. I've seen some data like that confirms that that's what's happening. But my attitude towards data that doesn't support my story is it's not good data. Ignore it. It'll be revised to show I was right after all. But seriously, I mean, a lot of these surveys have been pretty useless. I mean, the ISM manufacturing survey has been too pessimistic. Consumer sentiment survey has been too pessimistic. The economy has done a lot better than you would think based on the surveys.
Well, that's why everybody has to subscribe to you to know the truth.
Well, thank you so much, Ed, for being here. I'll now ask Louis about some key upcoming earnings. Let's start out with AEM. How is gold pricing shaping expectations this quarter?
Well, I've owned this gold stock for a long time. This is one of 20 gold stocks I own. And gold prices are still very high. In fact, as we record this today, gold's going up, silver's going down. So gold is a much better investment than silver, in my opinion. Silver did go up on demand, but it's just inherently volatile. I think a lot of the options speculating silver kind of caused a lot of its gyrations. We call that the tail wagging the dog, because a lot of people were in leverage options or ETFs. AEM's sales are supposed to be up 55.1%. The earnings are supposed to be up 109.8%. We do have positive analyst revisions, board analyst revisions in the last 3 months, and this company has a very good earnings surprise history. So this stock should rally on its earnings.
Now for AppLovin, what should investors watch in ad demand and monetization?
Well, there are two AI appliers out there. AppLovin, APP, of course, and then Palantir. And, they both are just spectacular companies, and Palantir already beat. But AppLovin sales are supposed to be up 17.4%. Their earnings are supposed to be up 48.1%. We do have slightly positive analyst revisions to the upside. And I own this stock. It's in my portfolio. I'm expecting great things. The stock has a good surprise history. Last quarter, the surprise was only 2.6. I would like to see a much bigger surprise and, of course, guidance. But from what I see, it's going to blow it out of the park.
Now for Ford, what are the key drivers to watch in this earnings report?
Well, Ford, their sales are supposed to be down 7%. Their earnings are supposed to be down 51%. But the analysts have revised their estimates higher. So in the last 90 days, they were estimating 6 cents, and now they're estimating 19 cents. That's a huge, huge upward revision. And last quarter, Ford posted a 25.4% surprise. So I expect them to surprise, and I expect them to guide higher. Obviously, all the money's made in trucks. Obviously, they've had the write-downs in the EVs. But, I'm expecting a nice surprise from Ford. I don't have it in my portfolios, but I wish them well.
Howmet Aerospace. Can strong aerospace demand support margins?
Oh, yeah. I mean, just look at all the orders Boeing has. It's ridiculous. In fact, Trump just got Boeing more orders from India. We just did this trade deal with India. But Howmet's a big supplier. We have this under management. We recommend our newsletters. The sales are supposed to be up 12.4%. Earnings are supposed to be up 30.5%. We do have positive analyst revisions on the stock in the last 3 months. And then I would add that it does have a very good surprise history. Not spectacular, but it should post at least a 4% surprise, if not more. So this is a great stock.
Now for McDonald's, what are you watching in global comps and traffic?
This is an extremely well-run company, and they, I think one of the things that helps them is they listen to their customers. And, when their customers are struggling, they have more Happy Meals or more special meal deals. Okay. Their sales are supposed to be up 6.9%. The analyst community has been steady with their earnings, virtually unchanged for the last 90 days. And they're expecting that they'll earn 7.8% earnings growth. So the only issue is they didn't surprise last quarter. And in fact, they haven't surprised 3 out of the last 4 quarters. So I think it's time for them to surprise. And like a lot of consumer-related companies, they're going to have to provide positive guidance.
On semiconductor, what matters most in guidance this quarter?
Well, we've had good news this week of all the orders for semiconductor equipment. Chip prices are going up. So ON should benefit, but believe it or not, their sales are forecasted to decline 10.8%, and their earnings are supposed to decline 30.4%. But the analysts haven't changed their estimates in the last 90 days, and last quarter they did have a 5.5% surprise. I'm betting they'll probably surprise, but obviously with negative forecasted sales and earnings, it's not going to be in my portfolio. But it'll be interesting if they can continue to surprise. All these companies have to give good guidance, otherwise they'll be ignored.
For Ferrari, does pricing power remain intact?
Yeah, I mean, the way what Ferrari does is they introduce a model and they collect the orders, and then within 4 years you might get your car. And the only problem is their recent models aren't maintaining their value as well as they used to, especially the hybrid ones. So that's thrown a little cloud over their cars. The other thing is their styling isn't as innovative as it used to be. And the cars now have more squarish fronts instead of beautiful rounded fronts. And they just look a little busy from a design point of view. You know, Italians are famous for their design. So I am not that optimistic on Ferrari. Their sales are supposed to be up 2.3%. Their earnings are supposed to go up 2.9%. The analysts have actually trimmed their estimates slightly. They have surprised for the past 4 quarters. Last quarter was a 4.8% surprise. So I think they will surprise, but I think they are struggling. And of course, they have an electric car coming out now too. And that might sell in Europe or other markets. I'm sure it'll sell in California. Normally EVs don't maintain their value. You know, an old EV is kind of like an old cell phone. So we'll see if Ferrari can change that. So there's just a lot of things changing for Ferrari, but I'm not that optimistic on them, period. They just too many complications lately.
Now for Shopify, what is the key metric to watch this quarter?
Well, they've been raising their guidance, and they have to continue to do that. Their sales are supposed to be up a whopping 27.7%. Their earnings are supposed to be up only 15.7%. The analyst estimates are unchanged with this one the last 90 days. But they do have a good surprise history. Now, last quarter, it was only 0.6% surprise. So I think Shopify is all going to be about guidance.
And lastly, for Vertiv, can data center demand drive another strong report?
It better. We own the stock under management. We recommend it. So their sales are supposed to be up 23.1%. Earnings supposed to be up 31%. We have positive analyst revisions the last 90 days. Last quarter was a 25% surprise. This company competes with Supermicro on the water-cooled rack systems, and Supermicro just announced 123% sales growth. So I'm sure this one will blow it out of the park. And I have extremely high expectations for this stock. Everything we've talked about, this one should have the biggest surprise.
Well, great. Thank you so much to you all for joining us this Sunday. We hope that you enjoyed our special guest. Please give this video a like and subscribe if you haven't already, but we will see you this Wednesday for a midweek update.